One of the things that we're seeing a lot of is directors that have received a director penalty notice, but that it's actually expired. So when the director penalty notice is expired, that director is personally liable for that debt. An SBR won't get rid of that expired personal liability. Is that correct?
That's correct. Yeah, like once it's expired, once you're into that lockdown phase, the only way to deal with it is in your personal capacity. So it's either going to require some payment, and usually, that's where, in circumstances where sort of tax insurance comes in, and you can organise that payment plan over time for the individual to deal with that personal liability that's attached. But it's still worthwhile in some instances, not always, but sometimes it's still worthwhile looking at the business, because whilst it might not fix that lockdown director penalty notice, the business may still need that breathing space. And the fact that the liability is a parallel liability, you might
Yeah.
get a discount in the company. You'll still have the personal amount, but the company will be able to pay a portion of that under its payment plan, which will reduce the parallel liability to the individual, and the individual can still be in a payment plan organised, through yourselves to deal with their debt over time, which just makes it gives them some breathing space, which means that the company survives, the business survives, and their means of income survives. But it's a case by case scenario, like with every
Yeah.
single administration.
We had an example of where an SBR wasn't the right solution recently. A client came to us and their super debt was 200,000. They had expired DPNs, and the difference between the company's liability and the director's personal liability was 30,000. And there was 80,000 of interest on the account. So they had received some advice that they should borrow against their house to pay out the 200 super, pay a different insolvency practitioner $20,000 for an SBR. They were only going to be looking at a portion of 30,000 in which they could potentially save. And what we were able to do in that case is put it all into a payment plan and actually look at an application to get rid of the interest and penalties, which meant they would have reduced the debt by 80,000, and they weren't taking out, they were actually going to both take money out of their house and money out of their own personal super to pay the company super. So I think the moral of the story, as it always is, that there is no one cookie cutter approach, and that's got to be the right advice for the right circumstances. There's other situations too, which I think people get a bit confused about, that an SBR is still in some instances considered as an event of insolvency. So for licensing and insurances, did you want to tell us a bit about that as well?
Yeah, for sure. Yeah, look at the mere appointment of a small business restructuring practitioner, and initiating that process is an act of insolvency in itself. And other creditors, whilst there's the small business restructuring is going forward, there's a moratorium. So similar to a voluntary administration, there's that moratorium where creditors can't actually take action to pursue guarantees and their debts and things like that. But if it gets out the other side of a small business restructure and the plan either hasn't been accepted or the decision period lapsed and there was no plan put, so the small business restructuring process is terminated, all of a sudden you've got an active insolvency for which creditors can then immediately proceed to winding up proceedings. They don't need to go through the creditor statutory demand process to create that active insolvency, because it's already been created for them. In terms of licensing, it's quite interesting how different jurisdictions are dealing with licensing. The building industry, for instance, usually it's the insurance that becomes a problem, which means that you potentially could lose your license, especially in Victoria, because you can't get insurance. Now, so far, we've seen, the experience we've had is that the builders have been able to retain insurance despite there being an external administration, and therefore been able to retain their licenses through an SBR. There's actually specific provisions for it in the QBCC in Queensland. So that also means that SBR is quite a good option around the smaller builders who want to try and retain their license. It's always a bit of a moving feast because we don't control the insurers, we don't control the VBA, but that's our experience to date. Is that's what's been happening in Victoria. And like I said, QBCC has its own rules, and
Yes.
they're sort of different all around the country. But for the most part, SBRs are going really well. And then in terms of other licensing, so we've had one with some liquor licensing, and that's been still okay. So it's definitely something to be mindful of, and sometimes that's why you'd choose an SBR potentially over a voluntary administration, especially around construction.
Thank you so much for chatting with me today, Shane. I think the moral of the story has been get advice, eat the frog, and plan your exit. So thanks so much for chatting to me today.
Yeah, no, thanks for having me as always, Olga. It's always great to chat.